2023 has panned out along the expected lines. At the beginning of the year, we had predicted that 1. Investors would earn a mid-single-digit return from Indian bonds in 2023, and 2. It would be a third consecutive year of low returns from the bond market. This is exactly what has happened. So as on mid-December, gilt funds have generated around 7.5% return over 1 year period, while their 3-year CAGR is below 5%. At the same time, AAA rated bonds have underperformed gilts as credit spreads have widened. On the other hand, credit funds have done better than both gilt and high quality bonds over 1 year and 3-year period due to overall improvement in the credit matrix. Apart from this, 2023 has pleasantly surprised us on both growth and inflation front. India's GDP was expected to grow at around 6% in 23, while inflation was going to remain sticky. In reality, India's GDP growth is likely to surpass 7% this year, whereas inflation is well behaved, barring a few small shocks from tomato and onions. Overall, 2023 has been a good year. The world is going to enter 2024 in a much better shape. Inflation, which has been the bane for global central banks since 2021, is on the wane and heading lower further. Global economy is also holding up remarkably well despite higher policy rates. Domestic landscape is looking even better. India's economic growth is quite robust, with GDP growing at 7% this year and at least 6% next year. Inflation is likely to average 5.4% this year as compared to 6.7% last year. Current account deficit is contained below 2% of GDP this year, while fiscal deficit will be met at 5.9% of the GDP despite higher subsidy outlays thanks to robust GDP growth in tax revenue. Going into 2024, we expect GDP growth to remain strong due to higher consumption. Inflation should trend lower towards 5%. Pickup in FPI debt inflows will also be a big positive for IGBs. We expect RBI to consider reducing rates in the second half of FY25. We expect IGB yield curve to twist flatter in 2024 with long-term yields falling more than short-term yields. This will mostly happen in the second half of 2024 when bond market will start expecting rate cut cycle to begin. On the other hand, corporate bond curve may experience upward pressure at the short end as there will be relatively more supply on the short end while there will be more demand on the long end. We expect credit spreads to widen in 2024. We think December MPC was more of a placeholder event as there were no major surprises in its outcome. The MPC maintained status quo on rates and voted 5-1 to keep the policy stance unchanged. This was the 4th consecutive status quo by the MPC. MPC did bump up its FY24 GDP growth expectations to 7% from 6.5% expectations last time. This was mainly due to robust growth in the second quarter and the higher momentum in the third quarter. MPC, however, kept its average inflation forecast for FY24 unchanged at 5.4% and indicated inflation to fall even further next year. All in all, RBI is anticipating a benign macroeconomic landscape in the next year with no material shocks on the horizon. We expect long-term government bonds to do well in 2024 as global central banks are expected to cut policy rates. In India, anticipation of FPI inflows in government bonds for index inclusion will drive yields of eligible bonds lower. Within this basket, we expect long-term government bonds to outperform short maturity bonds. We also expect short-term credit spreads to widen in 2024 due to higher primary supply and lower demand. Based on all this, investors should start raising duration in their portfolio mainly through government bonds for higher carry and potential price appreciation down the road. Happy investing, Happy New Year.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.